How does quitting your job forever and living your life on your own terms sound? Sounds pretty good, right? Well, that's the power of building wealth through smart investments, even starting with just $5. Just ask Warren Buffett, the Oracle of Omaha himself. Remember that working endlessly indefinitely is never sustainable nor desirable. Everyone deserves the autonomy to lead their life on their own terms, and achieving this entails allowing your wealth to grow through investments and assets. Think of your money as a tool that can help you enjoy your life more. Instead of just keeping it in a regular bank account where it grows slowly, you can use it to buy things that have the potential to make more money over time. This is like planting a seed and watching it grow into a bigger plant. The cool part is that not only does the initial amount you invested grow, but the money it makes also keeps adding up, making your wealth grow even more. So it's like a snowball effect where your money can increase a lot if you let it work for you in the right way. In this video, we're gonna dive deep into this idea. Basically, the more you put into things like stocks and other money-making stuff, the faster your money grows, helping you reach financial success quicker. And here's the thing, you don't have to start with a ton of money for this to work. Real estate might be pricey, but you can get into things like stocks that pay you dividends with as little as $5 a day, week, or month, whatever works best for you. It's all about making it doable and comfortable for you. Guess what? Warren Buffett, that super successful investor guy, gets a whole 71% of his cash from dividends, and it's all from just 5 stocks. Now, you'd be surprised to know that you can kick it off with a mere $5 and turn it into a fortune. That's the kind of thing that can help you retire early and live off what your investments are pulling in. So how does Buffett pull off this magic, and more importantly, how can you do the same? Stick around as we figure out how to get into the dividend game just like Warren Buffett. But before that, hit that subscribe button if you want financial stability in your life. We're here to motivate you. 57.7% of Warren Buffett's $375 billion portfolio is invested into 2 dividend-paying stocks, Apple and Bank of America. The answer to why is, I do believe in dividends in many situations, including many of the ones that companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain. A practical strategy for leveraging compounding is the 5-to-1 rule. For every $5 spent on liabilities, allocate $1 to assets. For instance, if you spend $15 at Walmart, invest $3 back into Walmart stocks. Similarly, an $80 expenditure at Costco means investing $16 in Costco shares. This approach ensures a balanced and strategic investment aligned with your spending habits, allowing you to benefit from the compounding effect over time. To truly grasp the essence of dividend investing, it's essential to understand that dividends are more than just regular payouts from companies to their shareholders. Dividends are like rewards that companies give to their shareholders. Imagine you own a piece of a company, and when that company makes a profit, they can choose to share some of it with you. That's a dividend. It's not just about getting extra cash, it shows that the company is doing well. Companies that regularly pay dividends are usually strong and can handle tough times. So dividends not only give you some extra money, but they also tell you the company is in good shape. Now, let's turn our attention to Warren Buffett, a name synonymous with wise investing. Buffett's approach to dividend investing is deeply rooted in his overall investment philosophy. Focus on value, not just price. Warren Buffett goes for companies that not only make money, but also have something special that keeps them ahead, like a strong brand, a unique product, or a top spot on the market. Just look at Buffett's list. With big names like Coca-Cola and Apple, these companies aren't just leaders. They're like rock-solid institutions that have been around forever. Take Coca-Cola, for example. They've been paying dividends since 1920, and everyone still loves their simple soda after more than a century. Then there's Apple, a newer player that's totally changed the tech game and has fans for days. Buffett's into companies that stand the test of time and keep on shining. What's really amazing about Buffett's approach to dividends is how he's all about the long game. He suggests picking stocks with the idea of keeping them for a seriously long time, being ready both financially and mentally. It's not about aiming for quick, high payouts. It's more about seeing how these dividends can grow over the years. Buffett's into the slow and steady buildup, where those little increases in payouts, combined with the magic of compounding, can turn small starting dividends into some serious cash flow over many years. As we've seen from Warren Buffett's take on dividend investing, it goes beyond immediate returns. It's about securing the long-term growth and stability of your investments. Another key aspect of this strategy, often referred to by Buffett as the eighth wonder of the world, adds a powerful dimension to dividend investing. When you get dividends, you face a choice: pocket the cash or reinvest it to buy more shares. Buffett is all about the latter. Reinvesting dividends means using your earnings to grow your investment, creating a cycle of growth that can result in exponential increases in the value of your investment over time. Imagine this: you invest in a stock that pays dividends, and instead of taking the cash, you reinvest those dividends. Now, you're not just earning on your initial investment, you're earning on every subsequent investment made from those dividends, all starting with that first stake. This can lead to a significantly larger portfolio over time compared to simply taking the dividends as cash. It's like supercharging your investment for the long run. Now let's check out some real-life examples that put Warren Buffett's compounding and dividend investing theories into action. Grace Groner's story is a classic illustration of how small, steady investments in dividend stocks can turn into something extraordinary over time. Back in 1935, Grace, a secretary with a modest income, spent around $180 to buy 3 shares of Abbott Laboratories stock. She held on to these shares her whole life, consistently reinvesting the dividends. Thanks to stock splits and the magic of compounding, her initial investment skyrocketed to a staggering $7 million by the time she passed away in 2010. Grace's journey is a compelling showcase of the impact of reinvesting dividends and the growth potential that a well-chosen stock can have over several decades. In another example, let me tell you about Ann Scheiber. She was an ex-IRS worker who turned $55,000 into a whopping $22 million by the time she passed away in 1995. How did she do it? Well, she invested in stocks that pay out dividends and kept reinvesting the money she got. She picked companies like PepsiCo and Bristol-Myers Squibb, and over the years, her money quietly grew into a huge fortune. Ann's story shows that even if you start with not a ton of money, it can turn into a whole lot more over time, thanks to this cool thing called compounding. Now let's imagine someone starting out at 25, putting $100 every month into a mix of different dividend-paying stocks. She keeps reinvesting all the money she gets from dividends, doing this for 40 years with an average yearly return of 7%, including those reinvested dividends. By the time she turns 65, her investment would have grown to more than $250,000. This made-up scenario shows how even if you're putting in a modern amount regularly, it can turn into a pretty big sum over a long time, thanks to the compounding effect. The main idea here is that when you're into dividend investing, it's not about starting with a ton of money, but being consistent and choosing to reinvest your dividends. The power of compounding in dividend investing is a reliable way to build up wealth over time, and it's something anyone can do with a patient and disciplined approach. Now that we've covered the compounding power and success stories, you might be thinking, how do I start my own journey in dividend investing? Well, the great news is you don't need a ton of money to get going. Just as little as $5 can do the trick. In today's digital world, getting into investing is easier than ever. Platforms like Robinhood and Acorns have changed the game, letting regular folks start investing with small amounts. These platforms are super easy for beginners to use. With Robinhood, you can buy parts of expensive stocks, so you don't need a lot of cash up front. On the flip side, Acorns is all about micro-investing. It rounds up your daily purchases to the nearest dollar and puts the extra change into investments. It's a pretty hands-off way to start building your portfolio, even if you don't have a bunch of money to start with. Starting early is super important when it comes to investing. Even if you're putting in small amounts, beginning early lets you make the most of compounding. Time is like a superpower for investors, and starting early gives your investments more time to grow and compound. Now, picking the right dividend-paying stocks is a big deal. You want companies with a history of steady and growing dividends. Usually, those are well-established firms that have a strong record of making money and staying financially healthy. When you're choosing stocks, think about things like dividend yield, payout ratio, and the overall financial health of the company. For research, you've got lots of options. Check out resources like Kiplinger's list of the best Warren Buffett dividend stocks. It gives you a peek into the kinds of companies Buffett invests in, ones with solid dividends and good growth potential. And there are always financial news websites, stock market analysis platforms, and investment forums to get more info. Here's the key. Aim to build a mix of different dividend-paying stocks that fits what you want from your investments and how much risk you're okay with. It's not about trying to pick the next big winner. It's about going for reliable companies that can bring in steady income and grow over the long haul. As we wrap up our talk about dividend investing, let's talk about the things you need to be careful about. Investing in the stock market has some risks, like prices going up and down a lot because of different things happening in the world. This can lead to losses, especially in the short term. But here's the trick. Think long term. Warren Buffett, a big shot investor, likes to keep his investments forever. This way of thinking is super important in dividend investing. Even when the market gets a bit crazy in the short term, thinking about the long haul helps you ride it out and benefit from the steady growth of dividends. Just remember, the stock market has a history of going up over a long time, even with those short-term changes. If you focus on the long-term potential of your investments and don't make quick decisions based on short-term market moves, you're following the smart approach of successful investors like Buffett. So when it comes to making smart money moves, here's a big tip. Don't put all your money in one place. That's where diversification comes in. It means spreading your money around different things, like different types of businesses or industries. Why? Well, if one area isn't doing so well, another might be, helping balance things out. Take Warren Buffett, for example. He's like the king of spreading things out. Even though he likes certain types of businesses, he has a mix of different ones in his portfolio, like tech and healthcare. Now, in the world of getting money from dividends, diversification means having a bunch of dividend-paying stocks from different businesses and maybe even different countries. This way, if one group of businesses isn't doing great, the others might be doing better, helping manage the ups and downs in the money world. It's also smart to think about other ways to invest, like bonds or real estate investment trusts as part of a mix. Keeping a long-term view and making sure your money is spread out are key ways to lower risks. By understanding and handling these things, you can set yourself up for a safer and maybe more rewarding money journey. Warren Buffett's success in getting money from dividends isn't just about picking the right stocks. It's about being patient, reinvesting, and using smart strategies. You don't need a ton of money to start. Just as little as $5 can do it. Remember, it's not about trying to be perfect with timing the money stuff. It's more about the time you spend doing it. Start small, think big, and watch your money grow.